Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's June 2nd, 2013. Markets had a second losing week in a row last week, for only the first time since last November, though the damage was fairly limited. On a closing basis, equities are only down about 2% from their high, which really isn't more than a blip in the grand scheme of things. Even so, equities will probably remain under some pressure until the jobs report on Friday. That should provide an inflection point for either continued declines or a manly in-your-face rally like the one we had last month that takes us to new highs again. There is one danger this time around, though, that's different, in that a really good report, better than expectations, something like 225,000, could rattle the markets into worrying more about the Fed's so-called tapering intentions, in which it begins to dial down on its quantitative easing. Those fears have caused the bond market to take some nasty losses in recent weeks, though some of those losses were tied to Japan and currency trading. However, that did lead to some panic in retail trading that the long-awaited bursting of the bond bubble is at hand. Well, the bond bubble is over in the sense that you shouldn't be buying long-term bonds to hold to maturity at all. However, I also think that there is another rally left in the 10-year Treasury back to below 2%, and one might even see a rally further out on the curve before the year is up. The U.S. economy is not doing as well as the equity rally would have you believe, an opinion shared by the bond folks at PIMCO, for example, who are holding to their forecast of 1.7% real GDP growth this year, and a Fed that is by no means done with its QE program. What the Fed would really like to do, in my opinion, is to keep working on the economy with its bond buying without the stock market bubbling up to crash heights. It'll be interesting to see if they can pull that trick off. In the meantime, like the PIMCO folks, I've been starting to nibble at bonds again as a trade. In case you're wondering, I have no prediction to make on the jobs report. The survey data I've seen doesn't seem particularly strong, and initial claims data isn't pointing to a strong report either. But the Labor Department's report is often quite a surprise and filled with revisions for many months afterwards. Seasonal adjustments often play a big role, and individual months can get revised for years afterwards. The consensus is for a number about the same as last month, around 165,000. However, the ADP payrolls report that comes out Wednesday will have a big influence on the expectations for Friday. Last month, when the ADP report came up short of estimates, and then the Labor Department report beat them, markets went delirious. So, we'll see what happens on Friday. I'm Kevin Flynn, and thanks for listening to Avalon's Market Minute.